If jobs available are going down, job openings, and unemployment's going up, that just basically means you have more people vying for fewer jobs, effectively. That's the first time that crossover's happened in a long time, but that's where you are right now. And so I think employers probably would do that. I mean, every employer I talk to basically says, I'll keep my good people, and if it gets tougher and tougher in here, we'll start at the bottom. The people are least effective, and they're out of here. And that's generally what we're seeing. You have to remember now, too, one of the big things going on in the country is housing, which is going nowhere. All right. And it's actually getting worse. So there's a lot of factors going into that, but it looks like it's certainly a negative to me. And the Fed just decided that's the way they want to go. I doubt if they're right. They usually are not right. And so if you look at the last 4 years, it's price. It's not the interest rate, but if you look at it, if you keep a high price and they keep moving the prices up, they were spoiled for many years where builders could come in and just raise the price. Rates were really low, so it didn't make any difference, actually. But now you get into a normal interest rate. This is not an abnormal time if you go back over 60 years, 70 years. And now you got a high price, and you look at high prices, then you got insurance, then you got taxes on that high price. And if you look at a 30-year mortgage today, it's only about a quarter less than it was a year ago. Even today, I'm talking about today. So I think people get confused on this. You'd have to have rates come a lot lower to effectively move anything on interest rates because the price is out of line. They're too expensive. I've got a graph of average hourly earnings just below the management level, and that graph always compares to the price of housing. The last time it was really out of line was about '06, okay? But now it's twice that out of line. In other words, it's so far out of line that you would have to have some of both. You would have to have your wages go up and your prices come down to bring that business back into equilibrium, because you can only make, I've decided to make smaller houses, but you get down to 1,200 feet or so. That's about all you're going to get here. You can't, what are you going to do? Throw up a 600-foot house and sell it to get in just to say I have a house? Well, no, because I can go rent something much nicer. So that business is in a quandary, I think. Now, you'll always have the buyers that buy, the upper level, upper mid to upper level range where they have the money. So that doesn't necessarily fit, but just in general, I'm talking about, that's what we see out there. But that has an impact on employment too. That industry touches a lot of people. So you just have to see how it works out. I think eventually, pretty soon they will. I've talked to a number of companies, private now, that basically buy, they're wholesalers, but they buy product to bring into the wholesale area. And what's been happening so far is those two have sort of split that a little bit so that on the retail side, they didn't get hit as hard. But they can only go so far with that. And after a while, they have to say, hey, you know what? Now we've got to pass some on. I think they're starting to pass it on, and you'll have to see how much they pass on, but we will get there. And again, that's going to show it in some of the numbers.
All right.
Well, I think you'd have to go, you look at right now, prime is 7.25 instead of 7.5. And in order to get people to take a lot of money, you've got to get it where it's cheap enough to borrow. To me, it's at a point where they can't get there because, you're going to have a prime that's 300 basis points lower than it is now. And you're going to have a situation where that would, some form or another, would get the long rates down to try to get activity going at the long end. That's another problem, though, because people see that inflation moniker out there and they're like, hey, you know what? I don't know what's going on. I know what's going on the short end, but on the long end, I'm not certain I'm willing to loan that money, like that. But if you go into a recession, they'll do the same things they've always done. They'll try to push it down. But right now, you would have to have a number that gets it down to where you could do business borrowing, to make businesses really jump out. And that's my opinion, having, own part of a bank and everything. But you have to get it down to where I could do that at 4% or 4.25, maybe 4.5. I can make those numbers work. And so I'll go ahead and build that building or buy that piece of equipment. That may not be right. That's just personal opinion, but that's the way I would see it. Well, if you look back in the 70s where Arthur Burns, he was succumbing to some of that pressure. So they would go up and down, but then every time inflation would be higher the next go round, a couple of years later, they'd have to go back in and, they had the win buttons and the whip inflation now and all that. When you get in a situation where you stack an independent board with people that are just going to do, for example, what the White House wants. And let me give you a real good example. Reagan did not agree with Volcker keeping the rates high. That's what broke inflation. But Volcker bucked the system and said, no, we're not doing that. We're going to keep the rates high. And that worked in the long run. But if you've got a whole group of people now that just say, we're going to do sort of what this particular party wants that's inside, regardless of the party, then I think you've got a real problem. Well, your rates would come down a lot. They would keep on bringing them down. You would juice everything again. Asset prices would even become more extreme. But the flip side of that is inflation would take off. You wouldn't see it immediately the first month, but then you see inflation just like you did, a few years ago. Remember when we hit that 9% level, then all of a sudden, here it comes. And inflation is a killer for middle income and lower incomes. That's the one that buries them. And then all of a sudden, then that throws the whole economy out of line. But then they'll learn a real hard lesson. That's what happens if you allow that to go on. I think generally inflation is going to be sustainable, though, between 3 and 4. That's why we don't own a lot of long-term bonds. They actually might work right in here right now for a little while, but we think it's a short-term phenomenon. What's happening right now is that you got two pieces of the economy, and the bottom 65 or 70% now, they're just barely getting by. So this inflation thing, which is still out there, by the way, is really affecting them. And so from that employment standpoint, that's a fact. But if you don't have customers coming through the front door, you're right, and you got a problem. And I think to a degree, a lot of the consumer companies, honestly, I think they've been living off the stock market because people had a lot of liquidity in that. It's gone up. They feel good. They spend more of that money. That's probably one thing that would affect it as well. But consumers, I think in general, have been living off the stock market. Well, investors right now are feeling good because the markets just go up. This market reminds me a lot of 1999. It just goes up every day. Nobody knows why. There's a narrative. They always have some sort of narrative, but they just go up. So nobody really does anything. They don't do any selling, and maybe they do more buying. I think now investors will try to chase the bonds, which is a mistake, by the way. Anytime you chase bonds, I think you're wasting your time. And what they should do right now, if they're worried about the rates, instead of keeping it short, like talking about in a money market or something, try to lock in a 1 year or 18 month, try to lock some of that money in. And if rates keep on going down, which they looks like they might, then you've got some of that money locked up, but you're not out 30 years. You're just out a year or two. And that's the only way to, in our opinion, to make that work. Well, I don't think you should chase anything now. If you look at our investing on the stock side, for example, we ride with what we have. We're still about the same, 40% in treasuries, 60% in stocks. We still own a lot of stocks, a lot of good companies. But the biggest mistake investors make, and we've all made this mistake, now I made it much younger, is that the market's been going up a long time. You think, okay, I want to pull the trigger. I want to get in. I want to buy more. I want to do, and you finally get to a point like Stan Druckenmiller did in 1999, where he said, I lost $3 billion in a short period of time. They asked him what he learned about it. He said, nothing, because I already knew not to do it. And I think people, they know not to try to speculate here, but they do it anyway. And this is a point where a good money manager will tell you, we're not going to buy that. I've already been down that road in my life. And you can't start to change everything you've ever known about value, what's worth this, what's worth that, and all of a sudden say, no, we're going to just jump on and try to ride this pony all the way. I think that's where the mistakes get made in this kind of atmosphere. For us, we look at the companies more than the market. Now, I will tell you, the market, I don't think they'll get anywhere close to hitting the numbers. They're looking at 16% of the estimates out there for increased earnings in 26. I don't think there's a chance they can make that. But what we look at are individual companies. And we see all kinds of companies. We don't own them. I'm just telling you, this is what you see. You see all kinds of companies that are selling at 40 and 50 times sales, not earnings. Sales, you see companies that keep on losing money, never made any money, their price goes up. There's so much of that out there right now, it's incredible. The leverage is out there. We're leveraged in every single area, private equity, private credit, all that. And those are the things that we look at to say, you can't play in that minefield because something's going to go wrong there one of these times. When it does, it'll blow up the whole thing. And I think that's what we look at. I could show you so many companies today that actually have zero value. If they handed you the whole company, you're not going to make any money. But people keep buying it and they keep throwing these narratives out. We like to buy companies that have real cash flow, real dividends. They're at a good value. They're at a cheaper price. That's how you make money in stocks in the long, long run. But at the top of these markets, you don't want to get caught buying into these things, because you'll look up 2 or 3 years from now, just like I said, and say, why did I do that for? And it's just because you can't help it. The greed button is coming, and people start to say, I've got to get more exposed. If you're younger and you have a lot of money, all of a sudden, you can put some of it in the market. I think you got to go low in the beginning, though. I'm talking about less than 20%. The balance, I think you have to keep, at least for the time being, in maturities that are 24 months or less, probably treasuries, maybe some higher grade munis. I do think there's areas you can own, which we own, that are cheap, may get cheaper in the short run, like energy, something like that. But go looking for companies that will pay you more than the 30. If you look at the 3-month treasury, it's just now gone under 4. So there's nothing in the treasury market that's less than 2 years now that'll pay you 4% anymore. That happened this week. So what happens is you have to decide, I want to own a little of some things that maybe would pay me 5 or 6 or 7, but they're in the dividend route, so I take a little bit more interest. So you get a balance. I think your balance right now ought to be towards safety, no matter how you balance it. If you're older and you have that liquidity event, you got to be careful. Well, I think people misinterpret gold. I mean, gold is something you buy for when things go wrong. Inflation, wars, countries all upside down, all sorts of things going on where there's fear. But right now, it's also an item where if you look at the level of debt for our country and all these other countries, then they don't have any faith in those countries. So I think if you're going to own bonds in here, and you can pick what you want to own, but I think if you're going to own bonds, you need to own 2-year or less treasuries, and you need to own a position in gold as a hedge. And people will say, well, what if it doesn't work? And it's an insurance policy on the long, long run, the rest of your life, because if you have a home, you'll buy insurance every single year for that house. But you better hope your house doesn't burn down, okay? Because then it pays off. But it's sort of the same way with gold. Just because you own it doesn't mean you're looking for some sort of extraordinary. But I still think it has, if you look at the setup for debt and the things that are going to go on this decade, I think you have to own some gold.